As the deadline for RRSP contributions near and tax season starting, it would be best to start thinking about making contributions to your RRSP. RRSPs are a great way to defer your taxes if your tax bracket is high. Hi, I'm Eileen. Welcome back to my channel. First, we'll go over what is a RRSP. RRSP stands for Registered Retirement Savings Plan. It is a savings plan that is registered with the Canadian federal government that you can contribute to for retirement purposes. It is a tax-advantaged account, meaning that the government created it specifically to provide tax breaks to anyone that uses it. So the money that you put into your RRSP is not taxed in the year that you make the contribution. So your money grows in your RRSP tax-free until you withdraw this money. RRSP contributions are tax deductible, so whatever amount you contribute can be deducted on your current year tax return, potentially reducing the total amount of taxes you pay. The idea is that while you're making money and contributing to RRSP, you pay less taxes. Or really, you're deferring the taxes that you have to pay right now to a later time, after you have retired when you're making less income. There is no minimum age required to set up a RRSP. However, some financial institutions may require customers to be the age of majority. You can set up and contribute to RRSP up until December 31st of the year you turn 71, as long as you are a Canadian resident, have earned income, and filed a tax return. You have the flexibility to hold and move your money between a wide range of eligible investments in your RRSP. These investments include cash, savings accounts, GICs, mutual funds, government and corporate savings bonds, stocks, and ETFs. For example, if you start putting away $100 bi-weekly for the next 30 years with an average rate of return of 5%, with compounding growth, you could save almost $181,000 in 30 years. The best way for you to know how much you can contribute for the current year is to check your most recent Notice of Assessment from the Canada Revenue Agency. But to provide you with a guideline, you can contribute the lower of 80% of the income you reported on your last year's tax return, $29,210, which is the max that you can contribute in 2022. In 2023, it increased to $30,780, or the remaining limit after any company-sponsored pension plan contributions. If you have a company-sponsored pension plan, your RRSP contribution limit will be reduced by the total value of pension credit you earn for the year. So be sure to check your T4 slip. This amount is referred to as a pension adjustment. Like I mentioned earlier, RRSP is a tax-deferred savings, where the investment income earned are tax-deferred and the contributions are tax-deductible. So it can help reduce the total amount of income tax you will have to pay. In addition to those, there are also other benefits, such as optimized deductions. You can carry forward your unused RRSP contribution room from years of lower income and use it in the future years when your income may be higher. This can help you benefit from tax savings when your tax bracket is higher. Income splitting. If you earn more than your spouse or common law partner, by contributing to their RRSP, it will help you reduce the total amount of tax you pay. Finance your first home or education. You can withdraw money from your RRSP without being taxed immediately when you're using the money to purchase your first home or for education purposes under the Home Buyers Plan or Lifelong Learning Plan. If you contribute more to your RRSP or to your spouse or common law partner's RRSP than the deduction limit, you have excess contribution. And when this happens, you would have to pay a tax of 1% per month on the excess contribution that exceeds your RRSP deduction limit by more than $2,000 unless you withdraw this excess amount before the end of the month when the excess contributions were made, or contribute it to a qualifying group plan. It is strongly recommended to check your deduction limit before making any contributions to not overcontribute. You can make a withdrawal from your RRSP anytime as long as your funds are not in a locked-in plan. But withdrawals are generally included in your income and are subject to tax in the year it was withdrawn. So typically it is not recommended to withdraw your RRSP early or before you retire. However, there are two exceptions. If you're buying or building your first home, the Home Buyers Plan lets you withdraw up to $35,000 from your RRSP. You have 15 years to pay back the amount you took out, starting the second year after you buy or build your home. With the Lifelong Learning Plan, you can borrow up to $10,000 a year from your RRSP or a maximum of $20,000 over 4 years. Again, there are rules about eligibility and how and when you'll have to pay this money back. When you withdraw from your RRSP before it matures, meaning the last day of the calendar year when you turn 71, you have to pay a withholding tax. Depending on the amount withdrawn and the province you're in, it can be as high as 30%. The financial institution where you hold your RRSP must deduct the withholding tax and send it to the government on your behalf. You pay income tax. The withdrawals must be reported on your tax return as income. You lose the contribution room. When you withdraw from your RRSP, you permanently lose the contribution room you originally used to make the contribution. When your RRSP reaches maturity on the last day of the calendar year you turn 71, you can access your RRSP through 3 options. Option 1. Make a lump sum withdrawal. The amount withdrawn will be subject to withholding tax. It gets taken from your withdrawal immediately and paid to the government. The amount withdrawn must be added to your income when you file your taxes. Option 2. Convert your RRSP to a RRIF, Registered Retirement Income Fund, which gives you a steady flow of retirement income with a minimum amount that must be withdrawn each year. You must make annual withdrawals from your RRIF, and these minimum withdrawals must be included in your taxable income each year, but they're not subject to withholding tax at the time of withdrawal. Any amounts withdrawn over the minimum amount are subject to withholding tax. Option 3. Purchase an annuity. You can convert your RRSP to an annuity, which offers guaranteed income for life or for a specific period of time. Withholding tax is not applied on amounts that are used to purchase an annuity. You may have to pay tax on the income when you start receiving payments. Keep in mind that the withdrawals can affect your eligibility on government benefits such as the old age security. Another thing to keep in mind, if you already have pension through your company, then your RRSP contributions may not bring you significant tax savings. Also, if you earn $55,000 or less a year, you may want to consider putting money into a tax-free savings account because those RRSP contributions may not bring you a significant amount of tax savings. I will discuss tax-free savings accounts in my next video. Finally, a reminder that the RRSP contribution deadline is March 1st, 2023. If you found this video to be helpful, don't forget to give me a thumbs up and subscribe to my channel. Thank you for watching, and I will see you in my next video on tax-free savings account.